Mills Corporation acquired as a long-term investment $240 million of 6% bonds dated July 1st and July 1st, 2018. Mills determined that it should account for the bonds as an available-for-sale investment. The market interest rate was 4% for bonds of similar risk and maturity. Mills paid $280 million for the bonds. The company will receive interest semi-annually on June 30th to December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, 2018 was $270 million. Because this is treated as available for sale investment, fair value will be used to report these investments on the balance sheet. Right now, when they first issued the bonds on July 1st, when they first purchased these bonds on July 1st, 2018, the journal entry will be mirroring the issuer's journal entry. Face value will price of the bonds will be on the credit side, and on the debit side, the investor receive investment in bonds. For the face value, they purchase these bonds using $280 million. The difference is a debit plug-in, and because the issuer issued these bonds at premium, the investor also call it premium. And the reason why issuer issued these bonds at premium is because face value of the bonds were $240 million, but the issuer receives $280 million, so the bonds were issued at premium. Record interest on December 31st, 2018. Effective interest rate will need amortization table. The investment starts at $280 million. That is the initial outstanding balance. And then 6 months later, they will receive cash interest based on stated rate 3%, because the bonds pay interest semi-annually. So 3% multiplied by face value. And effective interest rate is the market rate 2% multiplied by previous balance. Difference between cash interest and interest revenue is the larger number minus the smaller number. Because at maturity, these bonds will pay back investors $240 million. So we should decrease $280 million. So we subtract 1.6 from previous balance. So with these numbers, we can generalize the second entry. The investor received cash interest of $7.2 million. The investor record $5.6 million of interest on the income statement. The incoming interest is called interest revenue. The difference between cash and effective interest is the amortized premium. Last journal entry, we started the premiums on the credit side. So to amortize credit account, we started on the debit side. So now we need to amortize that debit account. We put it on the credit side. The third requirement says to record the value at the end of December 31st, 2018 for these bonds. Because they are available for sale securities, we report them at fair value.